Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Stephen Major joins us, legendary at HSBC's global macro advisor, now at Tradition, and we're just thrilled he could come back on today. Stephen Major, congratulations on this effort at Tradition. You are associated with a belief in price up, yield down. Do you maintain a structural dampening of yield into the coming years?
Short answer is yes. The elaboration on that, Tom, is that the returns on offer from fixed income are really quite healthy. And if you think about the amount of cash that people are holding, so is it some $7 trillion in money markets now? I think before I started my garden leave 6 months ago, it might have been nearer 6, but $7 trillion in cash, that's not going to be earning what it was at the start of this year. So there's plenty of cash to go into fixed income here. Now, if you look at the returns of other asset classes, it gets quite interesting. You know, I get people asking me about gold, about Bitcoin. What do I know about that? But people ask. And you look at it, just about everything's given you a good return. S&P 500, obviously, we know the numbers there. The bond market's had a positive return. Gold is on a tear. Gold just goes up every day, it seems. Bitcoin not. But then again, it's all about the context of the last few years of performance. So it seems that most people are going to go into 2026 with a healthy return based on whatever they've got. Right? I think most people have done all right. The question is, how do you set your portfolio up for 2026? And I would say bonds have a central place. I mean, if you can get 5-6% return in the next year, you should be happy. The trouble is, people aren't happy with that. They're greedy. So that's a slightly longer answer.
Steve, we've seen since the beginning of 2025, when we had all that uncertainty about the tariffs and introduction of the tariffs and Liberation Day, a lot of most risk assets have rebounded. One that has not has been the U.S. dollar, still down about, 8, 9, 10% from the early year highs. What do you make of the U.S. dollar here? Yeah,
Paul, it's context. Because we're down on the year, but on the last 5 years, we're up by a similar amount.
Yep.
So 5 years is an investment cycle, business cycle sort of time period. So yeah, the dollar is down. It could be down a lot more. If you told me some of the things that have been happening this year, I mean, you go back to the start of this year, if you had known some of the steps that have been taken, so you mentioned tariffs, but you could also talk about the Fed chair, for example. You could talk about the data releases, what happened at the Employment Bureau, all these things. I mean, I've forgotten half of what happened this year already, but if you told me these events were going to happen at the start of this year, I'd say, yeah, the dollar would be down. And so is the dollar down by more than we would reasonably expect? Well, it seems okay. Yep. And actually, in the context of the last 5 years, it seems okay. And when people tell me that there's a de-dollarization going on, I don't see it in the data. And I always ask, well, what else are you going to hold, actually?
Exactly. Yep.
And so it's an unsatisfactory answer because it's the same answer to the same question. But I'm afraid it's still the case that the dollar is something that you have to hold. It takes a big chunk of everyone's portfolio. I live in a region in the UAE, in the Middle East, where many currencies are linked to the dollar.
Exactly.
There's no evidence of that changing. So, there you go.
Stephen, in the U.S. Treasury market, we've got the 2-year at 350. We've got the 10-year at, call it 415. So 65 basis points or so there of steepening. What does that tell you?
Well, the steepening has come from the front, hasn't it?
Yep.
In fact, you pick your point on the curve, the middle point, let's say 7s to 10s, has done very little, which means your positive total return this year of best part of 5% is coming from the coupon. You just clip the coupon. That's fine. But if you go to the front of the curve, those yields have come down a lot, which means the Fed has cut by more than most people expected at the start of the year. By definition, for the yield to fall, it had to beat the forwards for you to make money, and that's what's happened. The longer end has slipped a little bit, but there's a lot of focus on this steepening of the US curve. Well, actually, it's a bull steepening. right? It's a bullish steepening, and many people who were calling steepening, I bet, were arguing that yields would have to go up in the longer end, and that hasn't happened. Now, it happened in Germany, it's happened in Japan, and the reasons are quite clear why it happened. It didn't happen in the US.
Stephen Major with us, folks, with Tradition, based out of Dubai in our London studios at Queen Victoria Street. And we welcome all of you across America, around the world, to the Pacific Rim. Good evening, and over to India and on to Mr. Major's Dubai as well. Steve Major, I look at the curves in the pros, you, Jim Caron, coming up with Morgan Stanley. Which spread is the best spread for our audience to study if they know there's 28 flavors of spreads? The vanilla spread is 2s as compared to 10-year, but which is the Steve Major spread that provides the most information and guidance?
Yeah, if you want one number on the curve, it's probably 5 to 30-year. You can ask Jim next, send him my regards, but Jim will have an idea as well. I think 2s, 10s can be quite distorted, because 2s is about the Fed. That it's as simple as that. 2s is not a credit risk story, it's not a sovereign risk story, it's not about auctions or anything really. 2s is safe, 2s is about the Fed. 10s starts to be a bit more cyclical, a bit more about the data, and looking into longer term sort of trends. I think 5s, 30s is your best measure of the curve, because you're capturing something that is close to where the Fed is and sensitive to rates, but not quite as sensitive as 2s. And I think it captures the whole story. 530s.
Let's stay on this, Steve Major, in honor of Jim Caron, physics major at Bowdoin. Let's just stay on the physics of the moment. And I want to look at the first and second derivatives of the way the curve is changing. Is there an accelerative tendency, or is there a quiet stability to yield dynamics right now?
Look, I think that the bond market has performed very well. And one of the measures, I would say, on the health of this bond market is the asset swap spread. So that's the difference between the treasuries and the swaps. When the treasury yield is going up at a faster rate than the swaps, you might infer that there's something amiss, there's something wrong with the treasuries. People are worried about the term premium and other measures of risk. They're worried about the longer term credit quality even of the US government. But the fact is those treasuries have been coming in. They've been doing better. The yields have been coming in versus the swaps. And it could be because they got oversold. It could be that the fiscal narrative has been overplayed. I mean, I look at the fiscal position of the US, I don't think it's that bad, but I sound like a heretic. But I'm just looking at the data. It's actually come in better than people expected. And the US Treasury is finding new buyers of its bonds. You can think about what stablecoin might do to the demand-supply dynamics longer term, for example. But I just think that there's a narrative out there that is just ready to go all the time, and it tends to be very negative on the US Treasury and on the US government. And it's willing this risk premium, call it term premium if you want, to be there, and it just isn't. It's nothing like what people had expected. The curve has steepened, but that's because short-dated yields went down. That's a very different explanation to the one that people were offering 1 year ago.
Stephen, if you look back on 2025, it's been a great year. I'm looking at the world equity indices, the WEI function on the Bloomberg terminal. Double-digit returns across the globe here on equities. We had U.S. fixed income, high single-digit total returns in 2025. What do we set up? What's the setup for 2026, do you think?
I mean, Paul, you're so right. You couldn't really go wrong. I'm sure we're going to meet people who did go wrong, but you just I think the biggest mistake anyone could make would be taking profits too early in this rally, and whether that's gold or S&P 500. And there are better people than me that are giving you explanations as to why this will continue in 2026. So it does seem that the economy is resilient. The growth numbers are robust. The Fed's going to be dovish. Whoever's going to be in charge will be cutting rates by more than the current chair, for sure. So that's quite a nice setup going into 2026. It's very difficult to see how this could be derailed. But that's exactly when you should start to worry. because when it's so obvious and everyone's doing the same thing, then you need to be diversified. And I'm meeting people that are not touching the bond market. They're coming up with all reasons for not holding bonds. That says to me there might even be a structural short out there.
Interesting.
That people are holding less than they need to of global fixed income. Don't forget, credit spreads are tight as well, again, relative to history. So to me, the government markets led by the Treasury, they look like reasonable value. You're going to get 5 to 6% total return probably again in 2026. I think the biggest problem is greed, that people expect that you should be able to make 10, 15% because they've got used to it. But I think we all know that that expectation isn't realistic.
Just along that line there, Stephen, spot silver hits fresh record above $70 an ounce. So the commodity markets are just going nuts. What do you make of that, of gold and silver and palladium and all those precious?
Well, we're quite big players in gold at Tradition, and the trend there is very clear. The people I speak to, the gold brokers, gold traders, are all convinced it continues. Again, the problem with gold, I think, for many people is they don't hold enough. So when something's going up, by definition, you don't hold enough of it, do you? So look, I can imagine that a personal portfolio should have 10 to 15% in gold. Institutions could be moving in that direction as well. And there probably just isn't enough gold in the world.
Stephen Major with us, and of course, based out of Dubai, and all of us work in Hong Kong, particularly during COVID. But he's in London. You know why he's in London?
Why?
Okay,
Christmas.
I mean, Steve, I don't care about the damn bond market. The idea that West Ham would be relegated and have to go down to the minor leagues is just anathema to me. I mean, Santos trying to get it done. They got Fulham here. Okay, I get it. Come on, Stephen Major, what does West Ham do to not... It's like if the Baltimore Orioles were sent down to AAA. Steve Major, what does West Ham need to do?
Yeah, I guess for those that don't follow football, one of the things that we're talking about here is that there's a 60,000-seater stadium, the old Olympic Stadium, that could be in the lower leagues, which would be a bit of an odd situation, right? But it's still, we're only at halfway on the season, and I think that West Ham have been a bit unlucky, to tell you the truth, and they haven't really had the rub of the green. So there's still time. I'm a patient man. I think let's talk again in a few months, and hopefully we'll be out of trouble.
It is still early in this season.
Yeah.
I love when they do this. They do this on YouTube when they show the highlights. They show the map of London with all the stadiums around. Okay. It's so cool.
Yeah.
It's like if New York City had 5 Major League Baseball teams.
Right.
It's very cool. Tell us about Dubai, Steve Major. In the time we've got left, we're going to go to an important interview here, folks, with Sir Mike over at Novo Nordisk in a bit. But Stephen Major, tell us about your in Dubai, the vibrancy of Dubai, what the Emirates have done with that airport, with that airline. What does the new Dubai look like to a global traveler like Steve Major?
It's getting busy. I mean, you can see the numbers. The population's north of 10 million, and it's nearly 90% are non-Emiratis, so foreigners like me. But the place is booming, and it's not just Dubai, it's Abu Dhabi and the other Emirates as well. And as you know, some of the big funds, some of the hedge funds have got as many people sitting in Dubai as they've got in London or New York. So, the numbers speak for themselves. And I think the geography, the location is very good, right? So the time zone works well. And then it's very high tech, and it's a can-do kind of society. So I think there's many reasons why people are based there.
Stephen Major with Tradition, as we celebrate his return to the street and look for his outlooks, very prominent out on LinkedIn with Tradition. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We continue looking at what we learn from yield. Jim Caron is with Morgan Stanley. He's been definitive for decades on yield. Jim, first of all, Stephen Major sends his kind greetings. He talked about, you guys go way back here in the battle. He has a structural optimism about fixed income. Grab the coupon. And he calls it a bullish steepener and that good things will turn out. Do you agree?
Well, first of all, good morning and Merry Christmas to you both. And Steve Major is absolutely one of the best in the business. I call him the James Bond of interest rate strategy. So I will say that, grab the coupon is definitely the way I'm thinking about the fixed income markets in 2026. And the reason that I say that is that when I look across the yield curve, how much do I believe that yields will actually be moving lower in 2026? I don't really think that they will. The front end maybe, because the Fed's going to cut, the yield curve's going to steepen. But for the rest of the curve, I think it's more of a sideways range. It may drift a little bit higher. So I think the most we can expect out of 2026 is the coupon and the yield in the bond, and that should be a good estimate for your expected return.
So how do you think about this Federal Reserve this year, Jim? We've gotten some cuts here. I think we're going to get maybe some more in 2026, but it's not a lockdown at this point. How are you thinking about that?
So look, I do think that the Fed's going to cut possibly 2 more times. And I know there's a lot of concern about the next Fed chair, whoever's coming in. I don't think it's about interest rate cuts. What I think it's really about is the overall regulatory aspect of the Fed. I think the next Fed chair and in President Trump's selection for the next Fed chair has a lot more to do about how the Fed will act as a regulator versus how they're going to think about interest rates. Look, there's probably going to be 2 more cuts. It's probably going to be under Powell. If another Fed chair comes in, is there another rate cut? Possibly, but it's really going to depend on the inflation data that's out there. So I'm not overly excited about that. What I'm really excited about is effectively what the regulatory nature of the Fed will be. And it does seem like we're moving into a zone, or at least a time period, where there's going to be a lot of deregulation. What
do you tell the equity beasts at Morgan Stanley? The fixed income people call the stock market people beasts. I mean, they're out of control. What does the bond market, Jim Caron, signal to people focused on the S&P 500?
It actually is a very positive signal for equities, because look, I mean, credit spreads are tight, yes, but they're not widening. Default risks are relatively low. We're not really seeing a material widening of default risks or increase in default risks. Interest rates, while they may drift a little bit higher in the back end, they don't seem like they're moving out of control. They might go a little higher, but certainly not to levels that I think will destroy the equity markets. So I think 2026, at least from the bond market's perspective, I don't think the bond market's going to get in the way of equities. I don't think that we're unless we get a shock higher in inflation, which is the risk, in my opinion, for 2026. If that happens, then all bets are off. But if that doesn't materialize, and I don't think it will, then I think it's really saying smooth sailing for equities. Equities have to make their own way, but bonds aren't going to be the hurdle that they have to jump over.
Historically, Jim, it's been U.S. large cap has kind of been the way to go. Is it time to think about mid caps and maybe even smaller cap?
So, this is a really good question. So I still think large cap is going to do well in 2026. Certainly a lot of the CapEx spending is there. A lot of the benefits from taxes are there. But I do think that 2026, and this is the way that we're positioning our portfolios across fixed income and equities, is that we do think that the cyclical components of the markets are going to see an upturn. So what we likely will see is the broader markets, the 493, right, outside of the Mag 7, will actually start to perform better. Now, why? Because what we're already seeing, if you look at confidence, if you look at even just the decline in interest rates that we've had over the past year, all of that works with a lag, and the cyclical sectors are likely to be what benefits from that. But it's probably not going to be, Paul, until the end of the first quarter. I think the first quarter of 2026 will still see the soft patch bleed over from 2025. And it's not until then that I believe that the tax policies, the fiscal stimulus, the lower interest rates, which act with a lag, will actually start to take hold. And I would expect the labor markets to even get better starting around the second quarter. But I still think there's going to be weakness in front of us, at least until March 31.
I'm just fascinated here. by Jim Caron, folks, in the physics of a 60-40 portfolio. We got three groups of people, Jim Caron. We got people that are standing at the dock, and after 3 years of double-digit equity performance, the boats really, really left the dock. We got people that did the right thing, 60-40, and they're like, well, I underperformed. I should have just loaded the boat on NVIDIA. And then we got people trying to find a new 60-40. What does Jim Caron's new 60% stocks, 40% bonds look like?
Yeah, it's this is a question of our time, right? So I think that the interest rate cycle that we have from 1981 to 2021 was pretty much just downward rates, which meant that bonds were stable. 60-40 as a passive way to look at the markets was a very, very good allocation. But now that interest rates are likely to move sideways over time, that means that 60-40 is no longer optimal. So what it means is that you probably need to have a bit more equity, a bit less bonds, because bonds aren't going to be the stable returns. Plus, bond return correlations are very high relative to equity return correlations. So therefore, one is not hedged necessarily against the other. So this is another factor that that we look at. So I would say it's a little more equities, a little less bonds.
Jim, I got the first look at GDP here. I know you haven't seen, the second look. I know you haven't seen this, but these are jaw-dropping Ellen Zentner statistics. I mean, this is unbelievable.
Great.
I got a GDP annualized, not 3.3, but a stick-up 4.3. I got personal consumption, thank you, Paul Sweeney, 2.7 up to 3.5. I'm eyeballing 7% nominal Jim Caron. What do bonds do in a Trump boom economy?
Well, see, that's the thing, right? We're getting much stronger than expected data. I think we're starting to leave this soft patch. And if we get this CapEx spending, which has been, going on in 2025, if that continues into 2026, and we get a furthering of the higher levels of productivity, then what that means is that you're going to get higher growth and lower inflation. So it doesn't mean that inflation, so right now we're talking about GDP growth being good, but inflation data has been relatively stable. Yeah. Well, the next inflation data is going to be the point. So if we have really high inflation for the next print, that's a problem. If we have stable inflation and we're printing these types of GDP numbers, that's really good, especially for equities.
Just extraordinary. Again, on that economic data that Tom was just referring to. Mortgage-backed securities, they've had a great year in 2025 on the agency side here. Is that still a call for 2026?
It's our highest overweight in our portfolio, especially non-agency mortgage-backed securities. The housing market, whether we look at the technicals, you look at the credit fundamentals, a lot of the regulation that came in since the financial crisis, Dodd-Frank, has meant that the credit quality of these assets is a lot stronger. The yield and the spread that you get out of mortgages relative to their equivalent investment grade or even sub-investment grade bonds is better. So you're getting higher quality bonds with a higher yield in the mortgage space. So it is an overweight for us. We're not worried about the housing market in this particular cycle. So we really like that. So yes, for 2026.
Jim, I got 30 seconds. Just give me the Jim Caron nutshell of 7% nominal GDP. It's like China. We have China GDP.
Well, at least for a little while, but yeah. So what it means is that bond yields are likely to drift a bit higher. I think that's natural, but it's not going to get in the way, and I think that's the key. So just because we see the 10-year yield, going up, doesn't mean it gets in the way of growth in the economy. Because if you're supporting a 7% nominal GDP, you would expect bond yields to be a little bit higher, but it's not going to be restrictive. So I'd say that the economy seems like it's running a bit hot, and inflation is not. So economy hot, inflation not. That is a high productivity environment.
When we invented this, folks, this is what it's about. Jim Caron setting you up for 2026. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We migrate to private credit. Paul's been anticipating this all day with Churchill Asset Management, giving us huge perspective in 2025. What does private credit and that wall of money do with an 8.2% nominal GDP? You and I have never seen this.
That's a big number. I'll bet you a lot of those are middle market companies, by the way, in service sectors, because we're seeing a lot of growth. So, yeah, I always come with a fun fact. So first of all, happy holidays. Great to be in the studio. We usually either have a strong fourth quarter and then build up the pipeline in the first quarter, or for whatever reason, not a great fourth quarter, but the first quarter is building. We've had both. We had, I think, a record fourth quarter, and we got a record pipeline for the first quarter. So I think this GDP report mirrors the confidence that our private equity investors have. And we've had a few of them on our podcast, just talking about the opportunities with these smaller companies and the growth, particularly in the service sectors, guys. I mean, this is where a lot of I'll bet you dissect that 4.3 and the 8%, that you're looking at. I'll bet you a lot of that's in the service sectors right now.
Just a Bloomberg headline kept coming across the tape here in the M&A space. ServiceNow to buy Armis for about $7.75 billion in cash. The deals are coming fast and furious. Talk to us about your pipeline for 26.
Yeah, so what's interesting about the pipeline now is with interest rates coming down and inflation kind of quiescent relative to the growth. And that's to be the case. I mean, we're seeing a really balanced macro. I was listening to Jim Caron before I came on with you, and I agree with 100% with what he's saying. It's very constructive for credit. I think that the deal flow that we are seeing now is mirroring the kind of deal flow we saw in 2019. It's pretty strong. I think interest rate being where they are is a big driver.
I like that. And, we all have our COVID stories, but I remember sitting in a chair on an island looking at a plane going over and saying, am I going to be on the last plane? And I was. Yeah. And the answer is that was a medical crisis. That was not a financial crisis. How does this end? If you have 6-7% nominal, if you have this K-shaped halves boom, private equity, private credit, do you have a theory on how this ends?
So, Tom, tell me. I can give you the theory if you tell me what cycle we are in right now. Are we in the 2010 to 2025 cycle?
The analog.
Okay.
What that well said.
Right. So, or are we in a mini cycle that just picked up after Liberation Day?
Or coming out of the 1890s, World War I got in the way. Thank you, folks. There was just a concerted technology lift.
Correct. And now with AI being, I'll bet you behind a lot of that, you're going to see a lift that's going to continue for a while.
I've never said the stuff we're saying today.
Yep.
8.2. This is
a good Christmas present.
It's a good Christmas present.
Do you need someone to empty ashtrays at Churchill, Paul? We'll get back into business.
No, you're doing the heavy lifting right now. This is great. Thought leadership. We love it.
Randy, what are your investors telling you these days? I mean, do they want you to, put more money to work or monetize more? What
they want it? They want it put to work quickly but safely. Yep. So they're worried about default risk, right? Okay. They're also worried about growth. Are we in a bubble, right? We talked about that a lot. Yeah. So KBRI came out with a really interesting stat. So they looked at the last decade. They looked at leveraged loan growth versus corporate lending growth. So leveraged loans including bonds, syndicated loans, private credit, 6% over the last 10 years. If you look at corporate lending, which includes C&I loans, so bank loans and investment grade bonds, 5%. Not much of a bubble there, 6 versus 5.
In the much bigger market cap than where you guys typically play in this Warner Brothers Discovery situation, there are debt deals flying all over the place. Yeah. Bridges are being refinanced here and there, and the banks are coming in and guarantees. The credit in that part of the market is everywhere. So what's it like in your market?
So when I got out of the University of Chicago and I was interviewing, my mentor said, talk about capital formation. This is in 1979. This is what we are looking at right now with private markets, because they are looking at taking away the opportunity for financing these deals that the banks had, but they've given up. You saw the announcement that leverage loan guidance was being removed. Everybody was like, oh my God, the banks are getting back into it. I'm sorry, but their cultures, the armies of risk and compliance people that have been built up in the banks over the last 4 decades,
Right.
those aren't going anywhere.
How do you hedge, folks? I should say, excuse me, Randy Schwimmer with his Vice Chair, Chief Investment Strategist at Churchill Asset Management. And a massive thanks to Stuart Paul. He's in the car already, isn't
Yes.
he?
Well, he's ski out. Yeah.
Oh, really?
Yeah, that's how he
didn't
rolls.
tell us that.
Yeah.
That's the way Anna Wong and the team
Yep.
rock.
Yep.
You know, it's like Lee Cooperman. They've got the backdrop behind them.
Yep.
They're on some island somewhere. Randy Schwimmer with us here. How do you pass off your risk? How do you hedge in the new world of private credit?
Well, we're actually not passing off the risk. That's the beautiful part about our model. We hold the risk along with everybody else. We're investing alongside everyone. The Lisa Mateo 401k, we talked about that last time. TIAA, which is our parent company, AAA company, holds the same risk that Lisa Mateo
This is
does
really
in her
important
401k.
Now. Compare it in the old days to the scam of a general partner with many limited partners that, I'm not going to go into the history, folks, but it ended ugly. It's a partnership.
Yeah.
I'm casually talking. But what kind of flavor of partnership is it?
It's a sharing of risk partnership, but a sharing of reward partnership. So all of the income stream that these loans are producing, which right now is close to double digits still because interest rates are high.
Like triple leverage all cash.
and this is with no leverage, okay? So the risk reward is very balanced. And looking into 2026, we talked about this. I actually think that with tariff inflation under control, that the macro risk, and this is Jim Caron's point, the macro risk is looking pretty strong. So now it's portfolio selection, fellas. This is what it's like. How does a bad loan get into your portfolio? The only way it gets in your portfolio if you put it there. So the whole thing is about asset selection and having 20 years of experience not doing bad.
I'm going to ask one more question because Paul's got 14. Okay, but then how do you get rid of a bad loan?
Well, you work it out, and that's what we do. And by the way, some people don't like being landlords. They don't like fixing the sink or the plumbing or whatever's going wrong. We are landlords. We take care of the properties. We own it. We fix it. We get it back in shape and allow the private equity sponsor to sell the business. We're not in business of taking risk on the credit side because we're not getting outsized yields. We're just getting our principal and interest back. So we're very conservative.
So do you hold your loans to maturity or until
they pay off?
Right.
It's very unusual for the loans to actually go to maturity. Something usually happens. The private equity firm will refinance, they'll sell. You guys came out with a great data piece on for the lead left this week on the leverage loan number of dividend recaps being done in this market in the leverage loan space at record highs for the recent quarter. So people are taking money out of these deals. They're giving those.
Now, will you finance that? Do you mind the private guys?
We don't mind taking some of the money, but we don't like them taking all of the money out because we like them to have some skin in the game. If you keep 50% of your money in, we'll do that deal.
Okay. Because is it still a tough market to monetize the investments for these private equity guys, or how's that going?
It's getting better. So you've got this trillion plus, iceberg that is slowly melting. The reason it's melting is because interest rates are coming down, and so financing costs, which is driving M&A, and you've seen now record M&A coming out of the chute, which is driving our deal flow. Interest rates make that possible.
I'm looking at this Jimmy O'Connor's in Windham Mountain. I'm fascinated by it. Road trip. We're going there. What's the sector you like in 2020? Does it have to be an AI deal to get done these days?
Let me give you a deal that we just approved in the linen management area for healthcare companies, right?
Okay.
You go to the hospital, some of it's disposable, but you've got the bed clothes and stuff like that. There's a lot of this under the radar stuff that's very cool and low risk.
You're Chicago. Top of the academic pile.
Yes.
What was your salary hope when you interviewed out of Booth?
Well, I think my first job, I was getting $25,000 a year.
$25K.
Yeah. The
fancy people were getting 40, and you'd never get there, right?
Exactly.
Okay, Lisa, we're doing the newspapers right now because I'm not here tomorrow or to the end of the year. Michael Arrowett, thank you so much for doing this. This is from Empower, the 401k people. Salaries Americans say they consider the minimum to be financially successful. Randy Schwimmer, 25,000. Boomers, 99,000. Rounded up 100,000. Fossils, Gen X, born after 65, 212,000. Millennials, 180,000. The average is $270,000 a year. Gen Z's clocking in at 587,000 to survive.
That's a wealth investor right there. We look at for that.
Goodness, there you go.
I mean, Lisa, what happened?
I don't. The kids come out with.
It's too expensive for everything nowadays.
Somebody had a beautiful vignette here of the starter homes we all lived in or rented. I mean, I lived above a pizza parlor, right down from Gitsy's White Hots in Rochester. The cockroaches would come up at night after the pizza parlor closed. I mean, we all lived in these dumps. I mean, except for Schwimmer. He was rocking it right from day one. And now these kids want a granite, they want the
They
mega
want the
kitchen.
Golden Goose sneakers.
Are you doing that tomorrow?
I don't know.
Andrew Felstead, go $2,000 sneakers.
No, thank you.
They just went for a bigger value. Did you do the transaction on Golden Goose sneakers?
No, I haven't seen that one.
It went for a bigger value than Versace. Golden Goose. Who knew? I walked by the store and I just, I try to distract the women when we go by the store. It's, fancy sneakers. Randy Schwimmer, thank you so much for being with us. Really appreciate you coming in. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get right to it. The newspapers with Lisa Mateo.
All right, I want to start with this big affordability issue. The price of new cars and trucks in the U.S. increased 33% since 2020. The average price of a new car broke the $50,000 barrier this fall. J.D. Power, the average monthly payment for a new car, it says it's estimated at $760 a month, which means a lot of families can't afford that. So what happens? Wow. Experts are saying the typical 48 to 60-month car loan term, well, it has given way to 72-month terms.
So that's
and even
6 years. Oh,
even longer. They're saying they're reaching 100 months or more than 8 years, especially when you get those larger pickups.
Does the article say what it's done to used car prices?
It hasn't said that, but it said because people have been holding on to their used cars for so long, holding out, that now they need the new car, and they have no choice but to kind of.
Yeah, and to me, it's the auto insurance. I mean, you used to pay $200-$300 a month, and those days are over.
Yep, it is crazy expensive. And then if you want to go like EV, you got to pay a premium on top of that.
At dinner last night, the entire discussion at dinner last night was electric utility bills. I mean, people are talking Red Sox baseball, or what the Bears did to the Packers. No, we're talking electric. Well,
that's how
the
governor-elect of New Jersey, she got hired pretty much on that topic alone. She's going to bring down utility bills.
Or so she said.
I wonder, is there an age cutoff for when you kick the youth off the auto insurance for home?
I don't know. Exactly.
How much longer do we keep them on the family plan?
Or keep them on the cell phone bill?
Just asking.
They're applying for Social Security and they're still paying for their cell phone bill. Next.
Okay, restaurants, they found a new way to fatten up your check, okay? If you've noticed, have you gotten the dessert menu lately?
Yeah.
And if you notice, are dessert wines listed on there recently?
Sure.
Okay, they've been doing it more and more. Long time, they're like thought of unsophisticated, too sweet, like people, But now they're on the menu because they cost a fraction of what reds would cost from a similar year. So, for example, if you get a glass of old wine from 1989, the sweet ones, it'll be $50, whereas a bottle from that same 1980s year will cost several $1,000s. So people are more willing to get the sweet wine at the end. And then because they have higher sugar content, the bottles can be left open longer. And so they can extend the life of the bottle.
I see what they're doing there.
See? And then it takes less, manpower to just offer a dessert wine than a fancy dessert where you need a special chef and you need, additional manpower to make it.
A Jameson neat, we're fine. That finishes up the night. That finishes up the night. Yeah, that's
what did you do when Bailey's was introduced? That was like the second coming of Christ.
Ignore that. Yeah. So in Northern Ireland, I have a problem because they don't have Jamesons in Northern Ireland.
Really?
Oh, they don't.
So, no. You have to get the other one. You have to get the Old Bushmill. You have to get Old Bushmill. It's a whole Northern Ireland, Republic of Ireland thing.
He's a font of wisdom.
I am.
I'm just going to be quiet and learn.
The world
What do you got? Do
traveler.
one quick.
Okay, this is the last one. Okay, we take it from sweet wine to beer. Okay, and the Wall Street Journal is saying this is not just any beer. It is a new version of Boston Beer's highly boozy Utopia's brand. It is the strongest yet. 30% alcohol by volume brew, illegal in 15 states. Just to give you an idea, traditional Sam Adams is like 5 to 6%, okay? But 30% puts it right up there with cognac, like the same kind of level.
You're really on a trend here today.
Hey, it's before the holidays. We gotta whoop it up. But they're saying don't try and make this at home because the beer is so strong it ate through the side of an insulated paper cup. So it could be dangerous.
And you're putting that in your stomach?
Don't know what it does to your insides.
Yeah,
but,
no thank you.
But apparently it's a small portion, like a little, niche aspect, but some people like it. It's all about for them the innovation.
Okay, well, thank you so much. Lisa Mateo, the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.